In August 2026, a rare pattern emerged in interest rate options. The market's implied probability distribution for future rates turned bimodal, with 2 peaks instead of 1. This is not a forecast of direction but a verdict on the Federal Reserve's credibility. A normal rate expectation looks like a bell curve, with a single peak around the most likely outcome. But in August 2026, the SOFR options market showed 2 distinct peaks, one near 3.5% and another near 5.5%, with a trough in between. This means the market sees a high probability of either a sharp rate cut or a sharp hike, but assigns low probability to rates staying near current levels. This is a direct challenge to the Fed's projection of rates hovering around 4.5% through 2027. To understand why this is so unusual, we need to see how options reveal market expectations. The Breeden-Litzenberger formula allows us to derive the market's implied probability density function from option prices. In plain terms, if out-of-the-money puts are expensive, the market sees a high chance of a rate drop. If out-of-the-money calls are expensive, it sees a high chance of a hike. In August 2026, both tails were expensive, creating the bimodal shape. The Fed's June 2026 dot plot shows a smooth path, 4.375% by end 2027, then 3.875% by 2028. But the OIS forward curve, which reflects market pricing, shows 3.85% for end 2027, about 50 basis points lower. More importantly, the options market reveals that this average is a mirage. It's the weighted average of 2 extreme scenarios. The market is not just disagreeing with the Fed, it's saying the Fed's path is one of many possibilities, and not the most likely one. 3 structural forces explain this distrust. First, fiscal dominance. With federal debt above $40 trillion and interest costs at 4.5% of GDP, the highest since the 1980s, the market knows political pressure will force the Fed to cut rates if the economy slows, even if inflation is above target. Second, nonlinear inflation risks. Core PCE is still around 3.2%, but the market fears 2 opposite scenarios, an AI-driven productivity boom that could cause deflation, or supply-side inflation from deglobalization and green transition. Third, credibility erosion. After the transitory inflation miss in 2021, repeated rate cut disappointments in 2024, and the early end of QT in 2025, the market no longer treats the dot plot as a promise. To quantify the disconnect, we can use the Taylor rule, a standard formula that prescribes a policy rate based on inflation and unemployment. With core PCE at 3.2%, unemployment at 4.1%, and potential growth at 2%, the rule suggests a rate of about 5.65%. But the market's implied median path is only 3.85%, a deviation of nearly 180 basis points, the largest since the 1990s. This gap means either the rule is wrong, or the market is pricing in a very different economic reality. Bimodal distributions in rate options are rare. They appeared in September 2008, March 2020, and March 2023. In each case, the market was signaling a major policy shift. In 2008, it was the financial crisis; in 2020, the pandemic; in 2023, the banking stress. Each time, the extreme scenario materialized, not the central path. The current episode has lasted 8 months, longer than any previous one, suggesting the market is even more convinced that rates will not stay put. In 2008, after Lehman collapsed, the market saw rates either near zero or high due to inflation. The Fed cut to zero and launched QE. In 2020, the pandemic shock led to an emergency 150 basis point cut. In 2023, the SVB crisis forced a pause in hikes despite sticky inflation. The pattern is clear: when the options market shows a bimodal distribution, the extreme scenario often wins. This time, the market is betting on either a deep recession or a fiscal crisis. Both would force rates to move sharply. Professional traders don't bet on direction when the distribution is bimodal, they bet on volatility. A strangle, buying both an out-of-the-money put and call, profits if rates move sharply in either direction. The current implied volatility is at the 85th percentile, so it's not cheap, but the bimodal structure suggests actual volatility could be even higher. A butterfly spread, which sells the at-the-money option and buys the wings, directly bets against the middle scenario. Volume in these strategies has tripled compared to the 5-year average, indicating institutional conviction. For long-term bond investors, the bimodal signal means interest rate risk is two-sided. The Sharpe ratio, which measures return per unit of risk, for the 10-year Treasury has fallen to 0.2, indicating poor compensation for risk. To protect against tail risk, investors might shorten duration to under 2 years or use swaps and options to hedge. The key is to stop assuming rates will revert to a stable path. For everyday investors, the message is clear: stop assuming rates will slowly return to normal. If you have a mortgage, a bond portfolio, or a stock valuation model based on linear extrapolation, you need to check your tail risk exposure. The bimodal distribution means the probability of a large rate move is higher than usual. Consider hedging with options or shortening duration. The new normal is not a specific rate level, it's the absence of consensus. The options market is telling us that the Federal Reserve has lost its monopoly on the long-term rate narrative. The bimodal distribution is a vote of no confidence in the higher for longer script. It's not a question of the Fed's competence, it's a stress test of the modern monetary framework itself. With debt above 120% of GDP, deficits above 6%, and AI and deglobalization reshaping supply, the market no longer believes in a stable path. The new normal is not a number, it's the absence of belief in any number. We'd love to hear your take on where rates are headed. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.